And of course, if something we find which is only applicable for a single stock, then probably it's just a statistical fluke. It is not really a tradable strategy. So what we'll do is that we'll approximate the opening range gap as a gap between the last high or low as it is applicable, whether it is up or down, versus the next open. And we'll approximate the subsequent move as the difference between the same day close minus the same day open. And we will be using lock prices just to make things easier for us. And let's see what happens. So what I'll do is that I'll quickly switch into quick and dirty way of doing this. I'll be using a bit of coding here. The coding here I'm doing is exactly what you mentioned. We are trying to get a bunch of stocks. We're trying to get their daily open, high, low, close data. We are computing the trading signal as the difference between today's open versus yesterday's low or high. And we are trying to approximate the subsequent rally or sell-off based on the opening, based on today's close versus today's open. So we have, this is R. If you're not familiar with R, it's absolutely fine. We could do it in Excel as well. We could have done it in any other language like Python. Excel, it will be a bit tough because the kind of operations we'll be doing, it gets very quickly very, very complicated in Excel. Nevertheless, it is possible. It is much simpler than if you really pick up a programming language. For this, I chose an R because I'll be doing mostly some exploratory analysis, which is essentially plotting some graphs. So I find it is a bit easy to plot graphs, beautiful graphs using R compared to any other languages. So here we are. So I have choose a range of stocks here: Microsoft, Apple, Amazon, Google. You see, it's not just one stock, it's quite a few. Actually, there are, I think, 20 or something. And then I have written some functions. So the first function is, you don't have to really look into it. You don't have to understand how it works, because I can share all the codes. You can have a look at them later at your leisure. Right now, it's important to follow the flow. So what we are doing is that we have a function that reads the data. Then we have another function that extracts those two signal and outcome we talked about. That is the difference between today's open versus yesterday's low or high, depending on whether the open was higher or lower. And the outcome we want to predict, which is today's close minus today's open. So we read the data, we read the stocks data, price data, and then we extract these signals, and then I have written a couple of functions just to plot. So if we do that, so we run the data, and then my data is, if you look at it, it starts from 2008. It ends at 2018 April. The X column represents the cases where there was a gap in the opening, exactly the kind of things we are trying to extract. And this value is the difference between the open minus last bar high or low, depending on whether it was positive or negative. And Y is the day's move, that is close minus open. X is the signal we are trying to capture. Y is the outcome that we are trying to predict. Now, let's see how it works. The simplest thing is that the first what we want to do is that we want to subset the data, because 2008 and till at least around 2013 was really a pretty different world. There was too many things going on: financial crisis followed by the European sovereign crisis. In between, you had the US Treasury crisis, the man-made one. But anyway, we'll subset it just to make sure that we are not sampling data that is no longer relevant. So we'll start from 2013, and then we'll plot the data. What we'll plot is a scatter plot, that is X versus Y, and see how it works. So we see that the green one is the cases for positive X, that is when there was a gap up. The red one is cases for negative X, that is when there was a gap down. Now we see that it is highly nonlinear. It's not very clear, but if you zoom in, you'll see that initially, as the gap increases, it tends to move in the same direction, but after a while, it flips. That is, initially shows some sort of momentum, and then it flips back to a mean reversion. What we'll do is that the X, just for your information, I have standardized. If you are not sure what is standardized is, you don't have to worry. Standardization is a method so that we can scale the value of X to something which is comparable, because we have picked many different stocks. They have their different volatilities, different prices. Something is trading at 20, something is trading at 1,000. And some may have some 20% volatility a year, some may have only 8%. So if we need to compare them, we need to standardize them. So it is a way of standardization. I've just done it by the standard normal way. So it will range from, it is basically scaled by the standard deviation of the underlying series. So if we see that the cases where our samples are within 2 sigma, that is our X is less than 2, the plot looks slightly different. Now, this is the one we are talking about. If you zoom in, if you zoom in, then you see that the momentum phase. So for small standard deviation, that is for small amount of gap up or gap open, gap down, it tends to move in the same direction. So what we saw in those two charts before, for one particular day gapping down and selling off, the other particular day gapping up and then rallying, seems not an anecdote, seems more like a statistical phenomena, because we have done this not for that stock, not even for that market. That was a Reliance stock, which is a large cap in Indian market. This is for S&P 500 stocks, top 20. So it is very different, and it still seems to be holding true. So it seems that there is some merit in that observation. It's not just a fictitious one. So let's go back and see that if we can do something about it. So this is what we have, just what you're saying. So first step, we define the rules. Now, there are too many text on the slides, so don't bother reading them. Just if you listen to me to be clear, what we are trying to do is that we are trying to translate our observation into very concrete statements or rules. Our first rule is how we compute the signal function. To do that, we first have to define what is opening ranges. So what you are saying is opening range is the first candle, that is the open, high, low, and close data for the first 30 minutes after the market opens. And we define the closing bar as the daily candle from the last trading day, yesterday. Again, open, high, low, close. Our signal function is first, we compute the gap between the opening range and the closing bar, and we normalize by the calculated volatility of the stock. If the closing bar high is lower than the low of the opening range, that is, it is a gap up, the signal is positive, and we enter whenever the high of the opening range is breached. we enter a long position, of course. And similarly, just the reverse for the short case. If the closing bar low, that is yesterday's yesterday's low is higher than today's high of opening range, that is we gapped down, then the signal is negative, and the entry level is the low of this opening range candle. So this is our signal function. That's fine. The second one is that how we define um, the position function. The position function is, we'll keep it very simple. What we'll do is that on any day, if you get any signals if you get signals for n number of stocks among 20, then we'll deploy our capital equally for all of them. The entry rule, only the first 1 hour after the opening range will be allowed to enter into a fresh trade. Once within this time period, we have the entry level breached, we enter a long and short depending on the direction of the signal. And our exit rule is that if we on a day have any entered trades, before 30 minutes of the market close, we check all of them and square them off. So it's a day trading. We wait till 30 minutes to compute the opening range from the market opens. Next 1 hour, we do all our entering. Next 1 hour, we wait for the opening range breakout. Once it's broken, we enter according to a signal. Then we do nothing. We wait for the whole day, just 30 minutes before the close. We square off our positions. Let's run the backtest. To do that, I'm going to use a platform called Blueshift. This is from QuantInsti. There is a platform to research your trade and also go live with your trade if you find a good one. It is a platform where you need to have familiarity with Python to code, because unless you are familiar with at least one programming language, it is very difficult to test your trading ideas. Excel is simply, believe me, is not enough. Even if you are able to express very simple trading strategy, very simple trading strategy almost always do not work in the market. You will look for complexity, and then Excel will become too complicated. Anyway, so let's go to the Blueshift. When you log into Blueshift, you will enter into a screen like this. This is what you call workspace. You see that there are all these folders and other things are there. So you can create a folder, you can get into a folder and create a strategy. You can also cut, copy, paste, and delete and do all those things. So what I've done is that I have created a folder called this, and I have some pre-built strategies here. And then we'll start with the logic of the first one, the very simple rules that we have just laid out, and see how it works on Blueshift. Now, mind you, we have some questions about some different rules. So the question is not what the rule is. So you can pick and choose whatever rule you want. The main focus is that we have selected a certain set of rules. We see that this is probably statistically, from a deep dive, probably statistically it is correct. And it seems that there are some momentum in the short range, as we have seen in these charts in the hour. And we just want to test it and see that if we can improve. And now it is not a lecture on how to use the platform. In fact, in EPAT, we have a detailed lecture on this because this platform can do many things, almost anything that you want to do with your trading strategy, including technical indicators and quant strategies and machine learning strategies, anything you can imagine. But today we'll be focusing mainly on the trading strategy that we are talking about, so we'll not discuss about all of them. What we'll do is that instead try to understand how it is coded here, very roughly, not from the point of view of how to code, but rather from the point of view of understanding it. If you need it, I can share all these codes later after the presentation, so you can go at in your leisure time. But now, as I said before, it is time to follow the logic. The first thing we are doing is that we are using some variable called context, which is part of. So we are defining a bunch of functions. So the first function is a function where we are defining some placeholders, some variables. We are initializing them as 0. So if you're not familiar with Python, do not worry. These are just means that they are set to blank things. Cool. Next one, what you are doing is we are first creating the universe. So in Blueshift, you have to tell what are the stocks you want to buy. And for telling that, we use a function called symbol that takes in a particular string and convert them into an object of type asset. So here we are creating a list of asset from this list that we have seen before in our R session. So in this, we are storing the list of stocks that will track. The N is the number of stocks we track. Here N is 20. All this, Microsoft too. I think this is MasterCard. Cool. Next is we need to compute the signal, the detailed rules that we have talked about. How we do it? It is pretty simple in case you are familiar with Python and if you are using Blueshift. I will tell you how to. If you are not following the programming part, do not worry. You can pick it up later, either going through the Blueshift material, which is freely available online, or you can join the EPAT sessions and you can get even more details on all of this. But the basic thing is that first we query the data, the historical data for all the stocks. So all these stocks we had, we query the data. So all those data is here. What we query? We query for open, high, low, close prices. For how long? For this number, which is down below 60. So we are querying for the price data for 60 days and daily price. 1D means daily, 1 day. Once you get the data, then we look through all of them and extract the price. So for this particular stock of this 20, we extract the price. We find the current bar. We find the last bar. And we also find all the prices, including the current bar. And also we compute the volatility. To compute the volatility, we are just importing a function from our built-in libraries. Once we do that, we first compute the gap up. The gap up is the current low minus the last high. Gap down is the last low minus current high. And then as we decided that we will be normalizing by the vol, so we are dividing the gap up by vol and gap down by vol. And our trading condition becomes, if this long condition is true, that is if the gap up is greater than 0 after normalizing with vol, then we are in a bullish phase. So we want to enter long. Similarly, if the gap down is large, then we are in a bearish phase. Otherwise, we are neutral. So this is a pretty simple calculation for computing our signal. And then we have also two other small functions. So what you do is that this function turns off our trading after a certain period of time, as we decided that we'll only be open to enter in fresh trades till 1 hour after the market open. And then another function to unwind or square off all our positions. Again, to do a square off, you have used another help function from our built-in library, this one. So again, this function will be called just 30 minutes before the market close, and it will square off. So now we have the main signal function. In signal function, what we are doing is that we are looping through all the stocks in our universe. We have, mind you, already calculated the the opening ranges and which phase we are in, bullish, bearish, or neutral. That is what we are getting here. And if the mood is bullish and the opening range is broken, we create a plus one signal. And if the mood is bearish and the opening range is again broken towards down, then we create a negative signal. And once we create this signal, we need to place trades. And the placing trades is happening here. We are computing the number of signals that we have, and we are computing how much we should allocate to each of the signal stock that we have. And then we just go on in a loop and we place the trades. So that's pretty much it. And then we basically schedule this functions here to call them in accordingly. So for example, the calculation happens after 30 minutes, as you can see here. We turn off the entry after 1 hour 30 minutes, that is 1 hour after the calculation happens. And we unwind after just before market close, 30 minutes before that. We also set the trading commissions and slippage there. Later on, we'll change it. Okay, and on every minute, this function is called automatically by the platform, and all it does is that whether we are in a trading state. If you are in a trading state, we just enter, right? I have already run the backtest. To run a backtest, what you have to do is to go here. You have to select the range. So, for example, we can select short range, and we can put some capital here and just run it. What you get here is that this is we called quick test, quick run. It will give you some headline statistics, and also it will stream you the output in real time as and when it happens. But if you really want to get more details and list of transactions and more statistical measures, you have to run a new backtest, which you can do from here in a very similar manner, which is fortunately I've already done it. So if you go to the backtest, quitting the quick run, and see how it looks like. So this is what our backtest is. It's not a great one, actually, as you can see. So we rallied up quite a bit in the beginning, then we had quite a bit of drawdown, and then again in the end we rallied up. So it's okay. It's not very bad. It's a decent starting point. But obviously what you need to do is to optimize. Back to optimization. So this is about the slide just you have seen, but we'll skip it. We already seen the real thing. So the question is how we go about the optimization. Before we even started, we have to first estimate what are the parameters in our strategy. So the first parameter is the signal threshold. Which is signal threshold? If we go back and see the strategy code, we see that we are entering or entering a long and short based on this condition. So gap up greater than 0 and gap down greater than 0. So 0 was the threshold for our signal condition. So that is the first parameter. Next one is the volatility calculation day, which was 20 day we just saw. Then other things are the 3 times, that is when we compute the opening range, when we stop entering fresh trades, and also when we exit the existing trade, square off. And finally, we had a binary position function. If you're not sure what is a binary position function, we'll talk about it a bit later. So what we have here is that we have a function, an objective function. Say, for example, if you just simply want to maximize our total returns, or you want to maximize the Sharpe ratio or anything you want. So that is, as you have seen, is a product of your positions versus the market returns. Now, market returns is not obviously under our control, so we can take it out of optimization equation. We can just simply multiply with it. And then it becomes a function of the signal, which is a function of our parameter space, the capital theta, and the input information, that is the I. The first thing people do is to run a search. So we have all these parameters, how many? Some 6 parameters we have. And what people try to do is that to run a search by changing the parameters within a range and see that what combination gives you maximum objective function, maximum Sharpe or maximum return or minimum vol, whatever. If you're doing this, you need to stop now. Many platforms actually offer this as a feature that you can run this exhaustive thing, or we use genetic algorithm or use simulated annealing or machine learning or whatever that. But this is a very, very wrong way of doing things. Why? The scientific way of developing a strategy is what you see on your left-hand side. That is, we ideate. That is where we started. Then we hypothesize. That is what you've done. And then you evaluate. And unfortunately, in most of the cases, the evaluation goes wrong. It is not as good as we expected, we hoped for, etc., etc. So what you do is that, ideally what you should do is that whatever doesn't work, we throw them away. Whatever works, we deploy, and you go back to ideation. What you end up doing is something that is depicted on the right-hand side, which is we evaluate, it doesn't work, we optimize, and then we deploy, and then we get into a circle. The backtests are useful for hypothesis testing. It's not a data fitting tool. If you are doing this parameter search to maximize the objective function, what you're essentially doing is data fitting. What you're essentially doing is optimizing your strategy for performance in the backtest. You're optimizing your strategy for the past, not for what you expect in future. That's one of the reasons that in Blueshift we do not offer such tools.